Okay, totally forgot to turn on my recording. So again, welcome everyone. So I like this class and I'm glad that you're joining me because I tell people all the time when it comes to preparing your finances, the first decision that you have to make is simple, which is to think like the wealthy. And the one thing that wealthy people do is they take the time to get educated. So by you being here and you signing in, you're right on track. I think it's remiss to a lot of people to try and do these things on their own, and they should get professional guidance, especially when it's being offered for free in a platform such as this matter. And the thing is, a lot of us don't grow up wealthy, right? You just need to know how to think like the wealthy. You also need to have the knowledge and the action, and that's exactly what I'm going to talk about today when it comes to your finances. Because a lot of people, they want to better their finances, they want to do better, they just don't know where to start. And one thing that we do know is that financial literacy, it is the largest economic crisis in the world. And just thinking about what we've experienced this year, even this week with the elections, not touching that subject today, but all these things can or cannot directly impact our finances. But the main thing is that we just don't want you to be taken advantage of. I don't want you to continue this sucker lifestyle because it does suck up your time, it sucks up your freedom, and it can eventually suck up your money. It sucks up your income. So, why are we talking about this thing? Because over 5 billion people in the world are considered financially illiterate. And there's all types of studies and references to back up those statements. I mean, our organization has even done a simple money quiz, and it has revealed that most people, they really don't know basic, simple questions and concepts when it comes to money. So, in this class, I'm going to go through a lot of concepts, forgive me because I will be kind of speedy through it, but I'm going to teach you those concepts so that you can look at, okay, where are my finances and how did I get here? And how can I see a way out? How do I see, a light at the end of the tunnel? And, it's funny because we don't learn this stuff in school. I tell people all the time, like, you can't blame yourself if you're not happy where you are financially because we don't learn it in school. Only 21 states out of the 50 in the United States actually require high schools to teach at least one class in personal finance. So we're walking away when we're becoming adults. We don't know how to balance a checkbook. We don't know how to pay bills, so many things. And then we're expected to all of a sudden figure it out. And it makes no sense. So that's why we do this course, because we want people to not get caught up in this sucker lifestyle. And this is exactly what happens to people. It's a trap where people are foolishly spending money, and but at the same time, if they're saving at all, they're receiving little to low interest on that money that they're saving month after month, year after year. And it really does take away your potential to grow wealth, to be free, to be in control. And I'm not saying you need a certain amount of dollars to be wealthy. As long as you have financial independence where you're not worrying, most people are living paycheck to paycheck. They are concerned about losing their job and it absolutely devastating their finances. We want to teach you how to not fall into that trap, and the bigger part of it is just breaking free from this sucker lifestyle. So when I think of like longer term goals like retirement, because a lot of people that I work with, like, that's their end game. Well, not necessarily their end game, but that's probably one of the biggest goals is, can I retire? And one thing I tell people all the time, it's like flying a plane. You need both wings to fly. And unfortunately, one wing, Social Security and your 401k, that's just one side. Most people plan to retire and depend on only those things. But oftentimes that's enough. We necessarily don't address the other side, which is our own personal savings. And most people, they're just not on track. They're not putting away enough money. And unfortunately, they're retiring prematurely, and they're not able to have enough savings to live a long life in retirement. So what does that look like? Let's say you even, do try to retire. The biggest question is, will you run out of money? Because people are living very long in retirement. As a rule of thumb, I tell my clients all the time, you can expect to be retired for the same amount of years that you have worked in the workforce. So if you worked a job for 30 or 40 years, you can expect to be retired for at least 30 or 40 years because people are living longer. But what happens is that when people retire without adequate savings, they don't have sufficient income, and they either have to go back to work, They have to significantly restrict their lifestyle, which is what happens to a lot of people, or they have to live with their adult children. So I'm not placing blame. I just want you to think about, what do I need to do so that I can avoid these things from happening to myself? And here's what it looks like when you actually do have enough savings. That retirement gap is closed because you've actually saved enough, and we know you have enough to reach that goal. This person will have reliable income. They'll have savings coming from their portfolio, their investments, whatever it is, to live a long life, but also to leave a legacy. I don't think about just what can I do in this lifetime, but I think about, what am I leaving behind for my children? What am I leaving behind for their children's children? So this is where you could really work with a financial professional to figure out exactly what your numbers need to be. But let's go ahead and get into some concepts, because that's what we're here for. We're here to learn. So I want to spend a few minutes to talk about the power of compound interest. And the power of compound interest refers to the growth potential of money over time by leveraging the magic of compounding, which is interest paid on interest, is paid on the sum deposits of all interest previously paid, or as Zoe puts it, interest on interest. So let's just break this down a little bit. There is a big difference between simple interest, which most folks are aware of. You set aside a lump sum amount of money, and then every month or every year thereafter, you're going to get the same amount of interest based on that initial amount. That's actually very much different from the way compounding interest works, because compounding interest is much more substantial. You're able to grow money on top of each other based on the amounts from before. Simple interest basically stays the same, and compound interest is where your money grows and grows and grows on top of each other. So one thing that I like to take time to educate is my clients about understanding the type of interest that they're earning wherever they're saving their money. In this example here, you can see that with simple interest, this person, 50-year-old, I'm sorry, not a 50-year-old, it was over a 50-year time frame. Somebody started out with a one-time $1,500 lump sum investment in a simple interest account that was earning them 9%. And somebody might say, oh, 9%, that's a pretty good interest rate. Where do I find that at? That's actually really great. But because this is actually simple interest, that $1,500 only grows to $8,250, which isn't a lot of money over a 50-year time frame. However, with someone taking advantage of understanding compounding interest, that $1,500 in the same scenario, earning 9% interest compounding, that same $1,500 grows to over $132,000 in the same 50-year time frame. That's approximately 16 times more money that that person would earn. And you can notice, the biggest thing to notice between these examples is that the curve of the graph actually gets steeper in the later years, because that's really when the power of compounding interest really takes off. So many people think that, oh, I can see a big growth right away within the first 1, 2, 3 years. It's actually something on the back end where you'll see your money really start to grow. And I'll illustrate that more when I talk about the time value of money. And when we really just look at the growth curves, $178 saved each month from ages 25 to 67 at different rates of returns, they create very different results. I'm going to show you that on the next screen. And most people really just don't understand that. It really matters where you put your money. And it unfortunately explains why people choose the wrong places to actually save the money that they do try to set aside. And the amount, so when we give, when we have fixed variable, when we have fixed, constraints, the amount per month and the time per month are the same. In this example here, we're showing again that person who's saving $178 from ages 25 to age 67. One person is saving it at a 1% interest account, the other's at a 3%, the other's at 6%, and then the other is at a 9% difference. As you can see here on the graph, the person who is saving 1% versus the person who saves 9%, earns 9% growth, that's almost a $900,000 difference. And so where you save your money and the rate of return that you earn on that money is the defining factor that closes your retirement savings gap, or it leaves you with a significant shortfall. And don't apply this just to retirement planning. I mean, that's what our slides use because it's a long-term goal, but just any financial goal that you have. where you save and how much rate of return you earn, the rate of return, the interest that you earn makes a big, big difference. So I mentioned a little bit earlier about the time value of money, and this is especially important in today's, when we look at today's world and the craziness that we're still dealing with. Unfortunately, a lot of people are squandering away their time when it comes to their money, when it comes to growing their money, and that is probably one of the most costly things that can happen to someone because you will lose the value of your money over time. Time is something that we just never get back. And when we never get back that time, we also never get back that money that we could have been earning, we could have been growing over that time. And there are three action steps to leverage the time value of money. Start now, save regularly, and be patient. So, without going, too deep into the illustration here, the whole point of this page is to say that starting earlier is always a good idea because it makes a significant difference. In this case, we have two people, Sarah and George, who are saving and investing their money. They're both saving their money from ages 22 to 30. Well, Sarah is rather, she started putting her money away at age 22 and then she stopped at age 30. George, on the other hand, said, you know what, I'll wait till later in life. I'll start saving when I'm 30. And he ends up having to save until he's age 67. Sarah comes out in the end by saving for only that, 8-year time frame. She grows her money to $1.4 million. George ended up having to save, an extra 37 years, and he still didn't even catch up to her. His money grew to $1.3 million. So, again, when we talk about saving money over time, we want to start as soon as possible. And here's a picture of the numbers that really does break it down by age. I really like this slide because it shows a hypothetical example of how much money you need to save to reach $1 million goal. And a lot of people, they in their heads, they think $1 million, that's it. If I had $1 million, life would be great. So, okay, let's look at that. So for each $1 million that you want at retirement, you can see that the monthly amount that you need to save to hit that goal is very different depending on your age. At age 30, you could hit that goal, if you're saving and earning 9% interest compounded. You only need to save $282 per month. But if you wait till age 40, then you need to save $731 per month. And at some point, you will outpace your ability to hit the monthly savings amount that's required. You simply can't afford it. I mean, what 55-year-old can say, oh yeah, I could put away $3,800 a month? That's not realistic. So at that point, you really only have two choices. You either have to shrink your dreams and your goals, or you have to find more money to earn and save. So I want to talk about this other concept. I actually have not talked about this in any of my presentations because I always have to skip it, but I'm not skipping it today. This is a concept called $1 million baby for those of you who have children or grandchildren that you want to leave a significant amount of money to. This is a very specific strategy. It's not for everybody, but again, because I keep skipping it on all my other presentations, I want to make sure I talk about it today. So we know that only 20% of children will actually receive an inheritance from their loved ones. And it's probably even lower now, especially with what's going on and that so many people have faced so many challenges in 2020. But let's look at this. Let's say if you want to give your children $1 million at retirement, which is more realistic, that you either give them $1 million in cash when they're adults, or that you've saved enough or you've actually developed a plan to save a fraction of that amount for each child when they're young. So again, you could either save and accumulate $1 million in a whole separate account, or you could develop this strategy that I'm going to talk about where you take a portion, a very small portion of that, set it aside and watch it grow to $1 million. So we know it is hard for older parents or even retirement age parents to really preserve an inheritance for adult children. The reality is that there are a lot of seniors, again, who are living longer. And almost all of their savings may have to go to paying for their own decades of expenses because we're living long. So it's not like you could just have this $1 million on your own and think that all $1 million will pass on. You're going to have to spend some of that money, for medical bills, long-term care. And the new reality of longevity is that it can possibly remove the opportunity for you to leave an inheritance at all to your children or grandchildren. So, could we use the money principles that we're learning today to save $1 million for your child or grandchild? And it's really easier than you think. And I'm going to go through a couple examples. So, in this example, Dana, our character here, this is the example one. She puts $13,000 aside just one time. She said, you know what, $13,000, this is for my grandchild. And she leaves it in an account that's earning 6.5% compounding interest every single month, until from her daughter, being born until her daughter turns age 67. So pretty much her daughter's entire lifetime. That one point, that $13,000 will actually grow to a little over $1 million by the time her daughter turns age 67. But what if you put away $13,000 for each of your children? Or let's think about if we did this later in life. Let's say you have children that are older, they're not babies anymore. You're like, Shantae, my baby's already grown. They're too small. They're not newborns for me to do this. Well, let's look at the implications of that. So let's say you wait until, or Dana, in our example, waits until her daughter graduates from high school and says, you know what, I'll gift you about $13,000. And then you still continue to save it in an account that earns that 6.5% monthly rate of return. That account now only grows to just a little over $300,000. So choosing to start when the child is a newborn or choosing to start when they're 18, it makes such a big difference. Makes such a big difference. Let's look at this example. Where we go? Okay. So in this example, Hector, he doesn't have $13,000 sitting around. A lot of folks are like that, right? It's like, I don't have that much of money sitting around anywhere, especially right now. But Hector still wants his son to retire with $1 million. So him and his family, all of his relatives, they come together and say, you know what, we're going to collectively, collect up and save up $2,500 together. We're going to save $2,500 now. And then their strategies that for the next 4 years, they're going to also continue to put in $250 each month into this strategy for the next 4 years. So that's $2,500 up front, and then an additional $12,000 over the next 4 years. And then, like magic, they'll hit the goal that way too. His son will be able to retire with $1 million waiting for him. Now, if Hector wants to wait until his son turns 18, then it's the same story as if Dana had waited. They're not going to earn a lot of money, just a little over $300,000 again. So this is a concept that we call the $1 million baby. And you can see why we call it that. Just think how appreciative would your kids be one day, perhaps when you're gone, that their parents or grandparent thought about their future, because their parent or grandparent knew how money works and they acted in love to take care of them. That's a thank you that I'm sure your future children and grandchildren would remember. And that's a legacy. That's what we call building a legacy. So I went through that very quickly, but if you're really interested in learning more about that strategy, definitely contact me. I'll be happy to send you more information about it. So as we move along, and again, you have to excuse me, I'm like getting out of breath myself because I'm trying to speak so fast. But I hope you're having fun. I hope we're learning. So this part is my favorite concept that I've learned since I've been teaching these workshops the past 8 or so years. It's called the Rule of 72. And if you've ever heard about it, or if you maybe not have heard about it, what it is it's a mental math shortcut that the wealthy have used for years. And I truly believe that everyone should know it. And what it does is it's a mental math shortcut to determine if you're saving your money in any particular account and knowing the interest rate that you're earning, how long will it take for my money to double? And you simply divide any interest rate into the number 72, and it will tell you how long it will take your money to double. And when I go through this rule of 72 concept, I want you to think of it working for you, which is when you're saving, you're investing, you're growing your money, but also to realize that the rule of 72 can work against you. And that's when you're borrowing money. So if you have credit cards, think about the interest rates on those credit cards. If you have loans, think about the interest rate on those, because again, dividing that interest rate into 72 will tell you how long your credit card, when your credit card balance will double, or when that loan balance will double if you don't pay it off. Um, so just real quickly here at 1%, it takes 72 years for $1 to turn into $2. Now, that's a really long time. And do you think people would knowingly choose that on purpose? I want you to keep that a question in mind, because I'm definitely going to come back to that. But as you can see here on this slide, the better rate of return you get, the faster your money can double. At 3%, now we're talking every 24 years, at 6%, every 12 years, at 9%, every 8 years, and at 12%, every 6 years. Now, I like that. Now, the number one question I always get when I teach this webinar is, Shantae, are there investments and things that I could do that can grow my money at 9 or 12%? Yes, there absolutely are. There absolutely are. If you want to learn about those, definitely talk to me and I'll be happy to share some strategies with you. But let's just move on real quickly. Remember that question about the 1% when I said, would somebody knowingly choose that? Well, yeah, a lot of people actually do choose that because they don't know how money works. And we know for a fact that there's almost $10 trillion sitting in savings accounts at banks that are averaging 0.09% or less. That's just a fraction of the 1% or less, zero point 0.09 or less. So when CNBC did a review of our book a few months ago, How Money Works, Stop Being a Sucker, this was one of the things that they pointed out because they could not believe it. And many of the actual institutional savings accounts rates are even lower than that 0.09%. You might even be banking at one of these banks. But when we think about let's think about what does that actually mean? At the average return of 0.09%, if you divide that into 72, you're looking at 800 years for your account to double. By the year 2820, so as George says, his great, 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 great grandchildren will love it, because then that's when they'll have the money. And so just so we're clear, let's think about it. Let's just take a step back to think about it. The same place that gives us the 0.09% on our savings, which is at the bank, will then turn around and charge us 17% interest or more on a credit card. So that means that their money, the bank money that you loaned them in your savings account, that's a loan to the bank, they're going to take that money and double it elsewhere every 4 years, more than likely is what, because they'll reinvest that money at 17% and they'll double their money every 4 years. But you, on the other hand, are putting your account that's doubling every 800 years. So that's why the subtitle of our book is called Stop Being a Sucker, because you need to know how money works today, not tomorrow, today. And I just want to throw a quick disclaimer. I'm not saying the banks are bad at all, but when you understand these types of concepts, one thing you will realize is that the bank is no place to grow wealth. It is no place to grow wealth. Is it okay to deposit and cash my checks there? Yes. Is it okay to pay my bills that and things that I pay for every day? Yes. But if you're going to think about significantly growing your wealth and investing money, the bank is not the place to do it. I'm telling you that now, and I'll hold that bias against anything, because the numbers don't lie. And these numbers clearly show you that the banks are not interested in growing your wealth. They're interested in growing their own wealth. So now that I've talked to you about a couple concepts, I want to take you through the 7 money milestones for the second half of this presentation, because it's one thing to, be badgered, and I don't want people to feel bad about their finances, but now that we already know that we need to do better. Like, you're watching this, you're on this presentation because you know that we need to do better. But what do we need to do? What step do I take first? Shantae, I know I need to fix my finances, but what do I do first? So I use the 7 money milestones process with any and everybody that I work with, because I know that it will help bring them from financial to, it help bring them to financial security and independence. And the good news is that no one is too far ahead or too far behind to benefit from these milestones. In fact, out of the hundreds of clients and thousands of clients that I've worked with and met with, I have never met no one to date, no one that has had 100% a financial plan in place that was absolutely right. No one, from my wealthiest multimillionaire clients to obviously lower income people, they don't have any plan at all because nobody would sit and talk to them. I have met no one that has fully ever had a financial plan in place that 100% worked for them. Nobody. So again, I don't want you to think that this is only for wealthy people or you need to have money. No, even wealthy people do not implement all 7 money milestones. So let's talk about this because each milestone is absolutely critical, step by step, to help you reach your financial goals. And because we're spending this time together, you're increasing your financial literacy, your financial literacy knowledge, concept by concept, strategy by strategy. You are learning to take control of your personal finances, and which that will help give you the confidence that you need to discuss your situation with a financial professional, which is something that I'm going to strongly continue to recommend throughout these next couple of slides. So the first money milestone is one that you're already on your way to completing. You begun milestone number one, and that's financial education. Is the first part of this session. You're becoming more financially ready with each page, especially if you've gotten this book. I know a lot of you actually have a copy of this book from me. If you have not followed up with me yet about your favorite part, let me know. I have not forgot about you. And actually, I'm going to take some time this weekend to reach out to all of you. And that's the first part. It's one thing to read a book, but the second part of this financial education is also remembering that a financial professional is the best person to turn to for questions on details specific to your situation. And we could discuss this with you if you don't have a financial professional to talk with. Well, hello, I'm right here. I'm happy to talk to you. Or if you need help choosing someone, I have no problem referring business to anyone else. But anyway, here's another way to say it. The first money milestone. Oh, I'm sorry. Here we go. Here's another way to say it. In the war for your money, there are two essential tools that you'll need to win. One is knowing where you start. And number two is taking this financial education that you're learning it and combining that with working with a financial professional. Take this stuff seriously. Like I said, we don't get this stuff from school. Our parents most oftentimes did not learn about these things, and our friends, they don't know what they're talking about. So just treat your finances with the level of dedication that you would put into your own health. You can Google things, you should ask questions for sure, but then turn to someone that you trust who does this for a living, day in and day out. So when we're talking about milestone number two, that's proper protection. And the word protection is having all things insurance in place. And you're like, well, why are we talking about insurance? Why is this the second thing we're working on? Well, you need to protect your family. You need to protect yourself, and you need to protect both of those things from a possible future loss of income or savings before you really begin the rest of this journey. This is literally the first thing that you should look at and that you should take care of before talking about retirement, before dealing with taxes, before investing your money. Having proper protection in place is absolutely the first thing that you should do, because if you were to die prematurely, your family could be left without your income in addition to being left without you. And your current savings, it might not be enough to take care of them. What if you lost your job or were injured and you can't work at all? What insurance do we have in place to be able to provide some financial support to our families, even if it's not just us dying, but when you are not able to actually provide and bring an income into your family? So the one question I want to talk about really quickly is, how much life insurance should you have? Life insurance is absolutely something that you should have and should talk to a professional with. I could definitely help you with that. But how much should you have? Because I find that some folks have some life insurance. Oftentimes it's not enough, or some people just don't have it at all. So the answer to how much you should have is totally based on everyone's different situations. But as a general rule of thumb, I recommend you considering having life insurance coverage that's at least 10 times your annual family income. So as an example, let's say you earn $50,000 per year. You should consider $500,000 in coverage, which that means is that at a conservative 5% rate of return, that would replace half of your income if you were no longer here. And for a more specific calculation of your need, this is when you want to sit down and talk to a financial professional, because that's where you could consider other factors like how old are you, how much debt do you have, your health, your number of dependents. If you're a business owner, like what's your role in your business, and just in general, your overall financial situation. And I will say this, the same people who underestimate how much life insurance they need, they have a tendency to overestimate how much it will cost. Because I don't want you to think that, oh, life insurance, I don't have it because it's a big, it's a huge expense and I don't want to pay for it every single month. First of all, it's not optional. And secondly, it's not as expensive as you think it would have been. That you think it'll be, because that assumption alone could keep your family from putting proper protection in place. And we want to break past that barrier. Statistics show here on insure.com, it says that only 59% of Americans actually have life insurance, and about half of those are underinsured. So I want to take a quick couple slides just to talk about life insurance because it's so important. And I normally actually skip through this part also, but I don't want to skip through that this time because life insurance it's a vital need. Like I said, if you don't do anything else with your finances, life insurance is the first thing that you absolutely should take care of. So that's why I want to spend time to talk about it. So first and foremost, life insurance falls into two basic categories. It's either temporary or it's permanent. That's it. Term insurance or permanent insurance. So let's look at temporary life insurance, also known as term life insurance. It's called that because it provides life insurance protection for a specific period of time, whether that's like a 10-year time frame, 20 years, or 30 years. And it's the most affordable life insurance available because it provides one core feature, which is actually a death benefit, which is the money that's paid to the beneficiary when the insured dies. And because it expires after the term. And I just want to clarify. So when we talk about expires after the term, we're talking about the cost that's locked in. It doesn't mean the policy actually cancels. It just means that the cost for that term insurance ends once you hit that 10, 20, or 30-year, whatever mark that is. The policy will actually still be able to be continued on. Your costs will just drastically go up. So I don't want to get too into the weeds to that, but I did want to mention that. So, with term life insurance, it's possible to have financial protection for your family or business that you probably need, but to have a very relatively small monthly payment. So, for those people who are budget conscious, this is when I normally have a conversation with them about term insurance because it will meet your need, but be at the lowest cost possible. So again, then we know that we can ensure that you're properly protected, that you can take care of your children. Um, if something happened, your mortgage could be paid off, school could be, money could be left behind for kids to go to school. Or if you are running a company, a lot of business owners, you need life insurance because as a business owner, you are valuable. You are an asset to your company. So think of what if I am removed from my business? Will my company still be able to, continue on? With having a proper life insurance plan in place, you could definitely probably meet that need. So again, what happens if the term ends? There's two scenarios that you could look at. Scenario one is that if you don't need the coverage anymore, you could just let your policy end. You can cancel the policy and it's done after that 10, 20, 30 years. No fuss, no muss. But what if after your term, you still need coverage because you're still paying off your home, or maybe you're a single income couple or a single parent, or maybe you're supporting your grown children or grandchildren. So, or if you're still running your business, for those reasons and others, then you might consider scenario two, which is actually keeping your term insurance. So, and this is where we look at when we look at scenario number two, and in general, when we look at having um, life insurance and when do we need it? Because I'm not going to sit here and say like everybody needs life insurance. 99% of the population does, but it's always strategy. When do we need it? Why do we need it? And how much do we need? And this is what we call the financial X wave. So on the I always get confused with the camera. But on the left side of your screen, you should see the blue curve, the blue section. Yeah, the blue on the left. So when on the left side, this is how we illustrate someone being younger. And when you're in your younger years, when you're younger in age, you typically have more responsibility and at the same time, little to no wealth. You have a lot of responsibility, but little to no wealth. However, in your later years, when you get to the right side of the curve on the yellow side, the plan is that you actually pay down all those responsibilities. We don't have a mortgage anymore. We paid off all our debt. Our children are grown and out the house to where now, and then at that same time, you've actually been saving and accumulating money so that you have actually grown some money and actually accumulated some wealth. If these two factors flip later in life, as we hope they do, then term insurance actually becomes less practical at that point. And then your financial professional can actually help you look at how the X wave could be applied to your actual situation. So now let's look at permanent life insurance. Like term, it provides a death benefit to your protect your family. However, permanent life insurance is designed to be kept and to protect you for your entire lifetime. It's permanent. It's not just a period of time like the term. Think of life insurance as like a lifelong strategy that can not only protect your family today, it can secure your wealth in the future and provide for your family long after you're gone. So there are three important benefits of permanent life insurance. It's not just, oh, if I die, that this plan would actually make sense. Obviously, that is number one, that you do have life insurance protection for your entire lifetime. Two, with many permanent life insurance policies, you can actually add long-term care features as an optional rider. I'll talk about why that's important in a couple of slides. And then number three, a lot of permanent policies will also allow you the opportunity to accumulate some cash inside that policy that can give you flexibility with the premiums. And if you ever can't pay your premiums for some reason, then that money then your premiums can actually be paid out of your cash value. So let's talk about what the cash value component of permanent life insurance is and why it can be so important. So a portion of your monthly premium is set aside in an account that grows over the life of your policy. The money in that account is your cash accumulation, and that can be used to fund future purchases. So, you can see a couple possibilities there on the screen. So, in addition to no market risk, which means we don't care what happens with the stock market, you won't lose money, you won't lose that cash value once it's there. You also get tax-free growth. You could create income for yourself, and again, you can leave a legacy, as we mentioned before. And then life insurance, the cash value inside of a life insurance policy, it's also creditor proof, meaning your creditors can't come after your money in your life insurance policy. And so when you look at all those advantages together, that cash value benefit is actually very, very possible. Not possible, sorry, very important. I did want to touch again on that long-term care insurance coverage that I was talking about earlier, because that can really help you cover out-of-pocket expenses that can really add up. And those can be used for paying for qualified services like nursing home care, home health care, assisted living care, or adult daycares. And you never know if or when you might need it. I tell people all the time, this is one of those things where you want to have it and not use it versus need it and not have it. Let's go on. Um, and the big thing is that if you ever do need long-term care, we have to know that the average long-term care need is more than 1 year. It actually lasts on average about 3.9 years. And as you can see here, the average total cost, it can be crippling expense if you don't have a policy in place to cover that. And the cost without long-term care coverage could drain either all your money, some of your money, or all of it. I have a perfect example of this. I have a husband and wife who started work with me a couple of years ago. Right now, the husband is in the hospital. He's had some significant medical issues, not to the point where he's no longer with us. He's here and he needs significant long-term care. Unfortunately, my clients had never had a conversation with long-term care with any other professionals before they started working with me. But by the time I started working with them, the husband actually didn't qualify. His medical conditions were already too far advanced, where the insurance companies, they wouldn't qualify him for it anyway. But I just share that because right now, the wife wants to bring him home. She wants to take care of him at home and have nurses come. They just simply can't afford it. So again, and this is not just for old people or seniors, and this is not just for paying for nursing home costs. I hear and talk to people and have countless conversations where they're dealing with long-term care needs. I had another recent client who, one of my really good friends of the family, whose mother just passed away. She had cancer. They intended to bring her home, and they were making plans to pay out of pocket to pay for a wheelchair ramp, to pay for, extending the door so that the wheelchair could get into the home. Those are things that regular insurance, health insurance, will not pay for. So these are perfect examples of where a long-term care policy or a long-term care benefit in a life insurance policy can take care of some of those things. So you're like, okay, Shante, I get it. What is that? How do I get it? So there's a couple ways that you can actually meet your long-term care need if there's something you want to actually purchase. So the first is a traditional standalone policy. So even if you don't have life insurance, you can actually go directly to an insurance company to purchase a standalone long-term care policy. Or you can opt to add in a rider to a permanent life insurance policy. And that is if it's available for your permanent, that's if it's available for your specific life insurance policy, that you would be able to add in long term care protection to it in the form of a rider for an extra cost. And that's the option that I normally recommend for everyone. I don't recommend buying a traditional standalone policy because number one, when it comes to long term care insurance, it's not a guarantee that you're going to use it. Yes, the statistics say that 70% of Americans will need long-term care, but what if you're one of the lucky 30% who don't need it? So I don't want you buying a whole standalone policy for something that you actually may or may not need right away. So it's a much more inexpensive option to just add it to your current life insurance policy, or if you're trying to buy a life insurance policy. So, when it comes to life insurance, long-term care is not the only other riders that you can add. There's other things. You can also consider other living benefits like critical and chronic illness riders that can help save the day if you face any of the health challenges like you see here on the screen. And you should discuss adding these riders to your permanent life insurance policy with your financial professional. Some are expensive, and some are expensive. And then some of them actually don't cost extra to add at all. Some insurance companies give these to you for free, but again, you want to work with a licensed financial professional or insurance agent to talk about those options. So once you have milestone number two covered, it's time to tackle milestone number three. And this is where you're creating your emergency fund. Any professional you sit with will always recommend to save 3 to 6 months of your annual income to prepare for unexpected expenses like unforeseen medical bills, home appliances, repairs, replacements, car issues, things that always seem to come up, and maybe even unemployment. Again, we're still living in very challenging times. So you want to have money set aside for all those what ifs. So here's the thing, if you're currently living paycheck to paycheck, like a lot of people are, your emergency fund really could be the insulation that separates you from financial disaster if something were to happen. So you can check out these sample annual incomes here and look at how much you'll need to fit our 3 to 6 month income guideline. But there are two rules. I tell people don't make this challenge, and don't look at this and say, oh, if I make $50,000 a year, I need 25,000. That 25,000 is not going to appear overnight at all. Just start working towards that. At least you have an idea of what would be ideal. Does that happen really quickly overnight? No, it does not. But the two rules, number one, when we start building and saving into an emergency fund, remember that it is actually only for emergencies. That's it. That's all. Not for dipping into for gifts, not for dipping into for getaways or buy one, get one sales. And for emergency fund, for me, it doesn't really matter if that sits in your checking or savings account or some type of separate account, as long as you're not tempted to use it for anything but a real emergency. Now, rule number two is if you need to use your emergency fund to fix a car, replace a fridge, or pay for braces, don't hesitate to use that money. That's what it's there for. I can't tell you how many people they're like, oh, I saved all this money and I had to spend it. I'm like, exactly. That's what it was there for. It was there so you could spend it when those emergencies come up and you didn't have to resort to swiping a credit card. And then once you spend that money, just make sure that afterwards that you add back a little bit of money over time to build it back up. So don't feel bad about spending that money. Now, once you work with your financial professional to square away your proper protection and emergency fund, now it's time to talk about managing your debt. So, which is milestone number four. Now, before you can fully enjoy financial security and independence, you'll really need to look at your spending habits and strive to reduce and eventually eliminate all of your debt. The average American today has $28,900 in personal debt, not including a mortgage. And many people have much more. And don't forget that over half of Americans suffer from some kind of anxiety relating to debt. And when debt is removed, that's when you can really enjoy life more fully and freely. things have been hard, with all that's been going on right now. So here are the 5 tips to eliminate and stay out of debt. First of all, know what you know. No more late payments. Go after one debt at a time. I see a lot of people who are throwing extra money toward their debt. They're putting like an extra $50 here, extra $100 there. Just put all of your extra money to one debt at a time. Stop charging and cancel unused subscriptions and consider refinancing your mortgage. So, increasing your cash flow is milestone number 5. And while the suckers gripe about how tight things are, the wealthy, they're always plotting how to free up more cash. And this means seeking out ways to earn additional income and be better about managing your expenses. So let's investigate how to do this real quickly as well. So here are a few things that you can do to increase your cash flow. First and foremost, create and stick to a budget. You want to develop a written game plan. Reduce spending on expenses like car and homeowners insurance. Reposition your savings. This is big for me because, again, a lot of people are actually saving money. They're just not saving it, in my opinion, in the right places. So I'm literally teaching people how to say, let's take money out of this pocket and put it into this pocket because it'll probably work better over here. That's repositioning your savings. That way you're not saving any more than you're currently doing. It's still manageable. We're just being more strategic and wise about it. Drop private mortgage insurance on your mortgage if you qualify. Contact your mortgage company for that. And always remember, your financial professional can help guide you through these ideas and many more. And here's a couple ideas to supercharge your cash flow. You can do what a lot of people are doing. We live in a gig economy that's having a side gig. Earning additional income is almost always a quicker way to reach your financial goals than just trying to spend less. Really, a lot of people I talk to, they're not overspending. They just don't have enough money coming in. So get a side gig. A recent survey found that 45% of U.S. workers have a side gig that's earning them an average of $1,100 extra per month. So maybe if you're thinking like, how can I have more money? Just consider that. Or maybe start a business. There are a lot of low cost business opportunities out there. I know I started my business for $100 and I'm doing what I do now. As Steve Sebo says, find a problem that people have and solve it. By becoming an entrepreneur part time, you could leverage time outside of your day job. And as your income increases, that's when a moment you could transition away from being an employee to actually being an entrepreneur where you have more control of your cash flow. And then the last quick tip is don't forget that you can adjust your W-2 allowances. So this is for those of you who are W-2 earners. The main thing here is that you really don't want to receive a big tax refund at the end at each year, because what that means is that you're actually giving too much money in taxes to the government and they're just refunding it back to you at the end of the year. You can adjust your W-2 allowances so that more of your cash can actually be in your paycheck now all year instead of it being with the IRS. So consult with your tax professional before making any changes. But I remember when I was a corporate employee, I think I was reporting like 99 on my W-2 because I didn't want them to take any taxes out. And then at the end of the year, I would owe very, very little or pretty much no taxes. But again, that's a strategy that you want to work with a professional to help you. So milestone number 6 is a big one, and it's an exciting one. It focuses on building wealth. This is the money milestone where results appear on your bottom line. This is where you would avoid the impact of taxes, losses, and inflation, and where you do your best to accumulate and grow your net worth. And like I've been talking about earlier in the presentation, when we're thinking about living a long time, that really just brings up one question, which is, will your wealth last as long as you do? And you have to be able to answer that question. That's not something that you could just push to the side and ignore. Um, in addition to that, when you're talking about growing wealth, there's really 4 threats that a lot of people have to deal with. Every wealth builder must conquer wealth, must conquer these 4 threats, which are procrastination, losses in the market, inflation, and taxes. And to beat them, we'll have to address them individually. So we'll start with the worst one, procrastination. As one quote says, procrastination can be hands down our favorite form of self-sabotage. And then we'll pick apart market losses, inflation, and of course, taxes. So inflation is also known as the tax of time. The annual inflation rate has averaged right at 2.8% for the last 100 years. So can you approximate the number of years that it takes the cost of goods to double at a steady 2.8% annual inflation? And if you just use a hint, just use the rule of 72 from earlier. It's time to put that knowledge of the rule of 72 to work. So the answer is almost 26 years. One of the essential reasons to build wealth is using the power of compound interest, which is to stay ahead of inflation. When you know that this enemy is slowly devaluing your savings by raising the cost of goods, it should drive you to be more committed to your growing building strategy, your growth building strategy. So don't let it scare you and let it drive you to action. Now, the next enemy to wealth is the impact of losses, which is often underestimated. It is a threat that you can wreck your savings goals and cost. I'm sorry, it can wreck your savings goals and force you to adjust your lifestyle in retirement. So here's a simple picture that illustrates how people miscalculate the impact of losses. If you were to lose 50% of your investment, which happened twice in the stock market in the last 20 years, I mean, we lost 30% back in March. What percentage of gain would you think you would need to have to grow it back to 100%? The answer is 50, right? No, it's not right. It actually takes 100% gain after a 50% loss to get back to being even. And that's not easy to do, which is why it's important to protect what you have. And maybe this is the reason that Warren Buffett famously said this about investing. Rule number one, never lose money. Rule number two, never forget rule number one. And so, what you can do to prevent losses is first, you got to look at every option to reduce the risk. And then, second, consider how to best diversify your portfolio. And then, third, use the right financial vehicles for your situation. Remember, don't procrastinate, consider inflation. And above all else, talk with your financial professional because this is what I specialize in. I teach people after talking to them and understanding, what they're trying to do and grow their money with. I teach them, okay, this is the best account you should save into, and this is how. So you want to talk to your financial professional about ways to reduce or remove the impact of losses from your future. There are financial products out there that can give you some guarantees where you never lose money. And the impact of taxes, the 800-pound gorilla of building wealth. Nobody likes paying taxes, especially when you're prepared for retirement. And the tax strategy you can put in place today can really determine how much money you keep, how much money you pay the government, and ultimately how much money you leave for your kids. So understanding the different financial vehicles that you save your money into and how they are taxed can definitely make a big strategic difference in the goals and the decisions that you need to make that will affect you down the road. When I work with folks on dealing with investing and growing their money, I actually start from a tax perspective. I look at what accounts are we paying taxes on every year? Which accounts are tax deferred? Actually, that's on my next screen. Let me stop. Okay, here we go. Yeah, which accounts are taxed now? Which accounts are taxed later? Or which accounts are taxed never? We want to think like a farmer. Do you want to pay taxes on the seed or do you want to pay taxes on the harvest? So, of course, whichever is smaller is the one that you actually want to start with. And as an investor, you would rather pay taxes on the money before it grows, not after. You either pay taxes now, later, or never. So again, everybody's scenario is different. Just start thinking which applies to you because it depends on the vehicle that you choose. And again, this is where a financial professional can actually help you. So there are three components of a reliable retirement income, and we recommend that you consider all of them. Maintain potential for growth by participating in the upside growth potential tied to the market. You're really best going to grow your money if it is tied to the market. That's not a given. Other people can invest elsewhere, but you really have to be invested in the market. And while you're invested in the market, then you want to reduce or remove potential for losses by eliminating downside risks tied to the market. And then let's create a predictable income. So there are ways to create like a little mini pension for yourself so that we can have predictable income that will last the entirety of our lifetime. And you don't have to run out of money. Or at least you can at least depend and have that guaranteed stream of income to count on. So I know I'm right at the 1 hour mark. I would say I probably got another 5 to 10 minutes. So I just want to throw that out there. If anyone needs to drop off, I totally understand. If however you connected to this webinar, definitely contact me if you need help with anything. But I just want to honor that time. But I do got about 5 or 10 more minutes. And so number 7, which is the last money milestone, protect your wealth by creating a will and guarding your legacy. And this is something that even rich people miss. Prince and Aretha Franklin, both whom died just a few years ago, had extremely sizable estates, but neither had an estate plan, and both had left their families and business partners with an emotional, financial, and legal mess taking years to sort out. And so this shows how important it is to protect your wealth and having an estate plan. So according to a Rocket Law survey, 64% of Americans don't have a will. And not surprisingly, the number is higher for younger Americans. 70% of those aged 45 to 54 than for older Americans. 54% of those who are age 55 to 64 do not have a will. So Prince, he was only 57. Your estate plan is how you protect your wealth, your family, and your legacy when you die or if you're incapacitated. It's how your wishes and decisions are carried out. And there are 4 documents your estate plan should include. You will need a will, your financial power of attorney, an advanced healthcare directive or living will, and a HIPAA release. So your legal professional can help you put all of this in place. I believe November is will month, something with the will. I'm actually very passionate about this topic. I talk about estate planning a lot. If you're interested, I have a couple YouTube videos that I recorded where I go in depth about a will and even a trust. And talking in depth how people should utilize those documents and when they actually need them. So, and I'll talk about the trust on the next slide here. I just wanted to mention that. But the whole point of having a estate plan is so that you can avoid the government making decisions about who gets your property and who takes care of your children. Because the process of when a court gets involved is called probate. And nobody wants to go through probate and having a judge make decisions for you and your family when you don't have to. So again, this is one of the most important reasons why you want to have your estate plan in place right away. So I mentioned a little bit earlier, you can also help your family and business partners avoid unnecessary expenses and delays with the probate process by having a trust established. Trust can do many things for you. Again, your legal professional can give you the best advice when it comes to trust. A trust is not for everybody. I'll tell you that right now. It's for some people, they absolutely need it. But if you want to learn more, definitely contact me. I'll be happy to have a greater conversation with you about that. And if you think estate planning will be too expensive or time consuming, then you really just haven't considered the cost to your loved ones down the road. Trust me, I've been there in my family and my personal life dealing with estate planning issues. And I work through a lot of issues with my clients to help them when they get into these estate planning issues. It's very murky, it's very challenging. And if you can avoid your family from going through that, you definitely want to have your estate plan in place. So I recommend that you put this milestone in place right away. So we're almost finished. I just want you to think about, what concept resonated with you the most during this presentation. That's why, me teaching these workshops, and I do it all for free. This is my mission because I want to eradicate financial literacy, but also to give people the tools on how they can start taking control of their finances. And the first start of that when I start to work with folks is completing what's called the money discovery. If you actually have the book, How Money Works, Stop Being a Sucker, it's probably one of the last 2 pages in the books of this particular PDF. So this works like driving directions on your phone. You just need 2 points of reference. 2 points of reference. Where are you now, and where do you want to go with your finances? And the same is true. Again, we were looking at putting together a financial plan. So the How Money Works Money Discovery in the book, it can help you take care of that. If you don't have a copy of the book, definitely contact me, let me know. Or if you just want a PDF copy of this, I have a PDF copy of this money discovery worksheet that's typable that you could fill in. But once you complete this money discovery, you want to give this to your financial professional who can sit down and work with you to make sure that you're on track to reach whatever your financial goals are. So discuss these concepts and review the milestones with the financial professional. If you don't already have someone to turn to, you can contact me. I'll be happy to sit down and have a conversation with you. Because the first steps, again, of the 7 money milestones is financial education. So hopefully you read the How Money Works book, but that you've already started working down the path of learning how it really works. And we can help you walk through the other 6 steps. If you want to work with me, I just want to explain how I work with folks. So first of all, I do that in 2 steps. The first is what I call a discovery phone call. And this is where we spend about 15 minutes identifying where you are now in your financial life, and most importantly, where you want to go. And then I'll sit back and take that information to my team, and then we'll spend a few days crunching numbers, searching the financial industry for the best products and services to meet your need. and identifying the ones that best fit your current situation and your future goals. And then after we have that phone call and I get all the information from you, I'll set a webinar appointment where we can actually do a screen share like this, and I'll walk you through the steps that I recommend for you to achieve your goals. So don't procrastinate. If you want to connect with me to have that discovery phone call, you can actually go to this website, www.bit.ly/talk to Shantae. That's bit.ly/talk to Shantae. All one word, all lowercase. So that's it. I'm going to actually stop sharing my screen. I thank you all for joining me today. Let me stop recording too. Yeah, there we go.